Let's look at the data. On the surface, everything looks great, right? But when you peek under the hood, the market's microstructure, well, it's telling a totally different story. We've got a major divergence here, and it's something we absolutely have to pay attention to.
So that brings us to the big question, doesn't it? Is this market rally even real? I mean, you see the headlines. They're all flashing green. But underneath all that, there's this fragility, this anxiety that feels like it could be a warning sign. So let's actually dig into the numbers and see what's really going on.
All right, so first up, let's look at the Dow. It finished the day strong, up over 1%. Now, on paper, that looks fantastic. It's a solid gain, the kind of number that makes you think, hey, the market's in great shape. And it's not just a Dow. The S&P 500 is right there with it, up almost a full percent. So again, this just feeds that story of broad strength, right? The 500 biggest companies all moving up. Everything looks healthy. And, to round it all out, the tech-heavy NASDAQ is also firmly in the green. So if you're just looking at the major indices, you'd be totally forgiven for thinking this is a solid, healthy, broad-based rally. But this is where things start to get really interesting. Because all that green you see on the surface, it's hiding a really severe internal weakness. And look, this is exactly the kind of market anomaly that can trap people who aren't paying close attention. So let's peel back the layers. This really gets to the heart of the conflict. I want you to think of it like a hollow army. You've got the generals, the big mega-cap stocks, and they're charging forward, pushing the whole index higher. But the soldiers, the vast majority of individual stocks, they're actually retreating. That, my friends, is a textbook negative divergence. Okay, to really get this, we've got to talk about something called market breadth. It's actually a pretty simple idea. It just tells us how many stocks are actually in on the move. Are we seeing a healthy rally with tons of support, or is it just a handful of heavyweights doing all the work? All right, now look at the hard data right here. On a day when the major indices are rallying, we only had 85 stocks hitting new 52-week highs. Now get this, we had 403 stocks hitting new lows. That's an almost 5-to-1 ratio of lows to highs. I mean, come on, that is a massive red flag. And believe it or not, it actually gets worse. A staggering 67% of all stocks are trading below their 50-day moving average. That's a huge short-term trend indicator. So what this is screaming at us is that 2/3 of the entire market is technically in a downtrend, even while the indices look great. The participation, it's just not there. Okay, so with all this conflicting data, it begs the question, what is the smart money doing? How are the big institutional players positioning themselves? This is where we need to hunt for the real signals of conviction. And this headline right here, it's a huge clue. A lot of this upward movement isn't because people are suddenly super bullish. No, it's forced buying. You've got hedge funds that were short, they bet the market would go down, and now they're getting squeezed. They have to buy back shares to cover their losses, and that creates this artificial demand that just pumps up prices temporarily. So if all that short covering is just noise, we need to find the signal in the static, right? Where are the institutions putting their real money with genuine conviction? To find that, we gotta follow the insider flows. We're talking about the legal buying and selling by the people who know these companies inside and out. And here is a perfect example of what that high conviction buying looks like. Check out this ticker, STAA. You've got Broadwood Partners, a 10% owner, buying not once, but 3 days in a row. First over $8 million, then over $10 million, and then they dropped a massive $22 million buy. See, that's not a panic-driven short cover. That is deliberate, aggressive accumulation. So, where do we go from here? What does all this mean for the market's direction? Well, the data really points to two very different possibilities. So let's break down the bull case versus the bear case. Okay, the bull case. The argument here is that this short squeeze could keep going, forcing more and more cash off the sidelines. Eventually, that money could rotate into these beaten down stocks and our market breadth would start to look a whole lot better. Now the bear case, those mega cap generals, they finally run out of steam. This awful market breadth we're seeing, it turns out to be the leading indicator it so often is, and the whole hollow army just collapses. Now look, it's super important to remember that this is all for educational purposes. We're looking at a snapshot in time, and this data changes fast. So you have to, and I really mean you have to, do your own due diligence before you ever make a move. Stay disciplined, stay liquid. We're tracking these flows in real time,
So while you're analyzing the next move, go ahead and check out the tools in the description. You can sign up for Public and get 20 bucks in free assets, check out Webull for that BTC promo, or maybe look into NVDA over on Moomoo. All the links are down below. And hey, like and subscribe for more of these deep dives.